Welcome back to the Deep Dive, where we take your sources, peel back the layers of information, and really unearth the most fascinating insights tailor-made for you. Today, we're plunging into a paper that truly dares to challenge one of the bedrock principles of modern finance. I mean, a principle that has shaped how we understand everything from why certain stocks go up more than others to how companies are valued. It's a paper so bold, it actually calls itself the Investment Manifesto, and it might just fundamentally change the way you think about asset pricing. Our mission today is to thoroughly unpack this provocative argument. The paper we're diving into is titled The Investment Manifesto by Xiaoji Lin and Lu Zhang, published in the prestigious Journal of Monetary Economics back in 2013. This deep dive is designed specifically for you, our curious listener, who wants to grasp the true forces at play in the market without getting, lost in a labyrinth of academic jargon. Okay, let's unpack this. Imagine just for a moment that decades of rigorous financial research, countless academic papers, even the way investment strategies are taught.
Imagine they're all built upon a single, deep-seated belief about how the world works. Now imagine a meticulously researched paper coming along saying, what if that core belief is, well, if not entirely wrong, then at least profoundly misunderstood or misapplied? That's precisely the intellectual earthquake we're exploring today.
Yeah, and what's truly fascinating here is that Lin and Zhang aren't just suggesting, a minor tweak to an existing model. They're not just fiddling around the edges. They're challenging the very questions researchers have been asking for years about what actually explains those puzzling patterns in asset prices, the things we call anomalies. So instead of just adding another layer to the existing framework, they offer a complementary and in many ways, I'd say, revolutionary perspective. They basically pivot our attention away from abstract, often hard to measure risk factors and redirect it towards the tangible, real-world investment decisions that firms themselves make. It's a shift, really, from the ethereal to the observable.
The shift from the abstract to the concrete decisions businesses make.
Okay.
To truly appreciate the punch, and frankly the audacity of this manifesto, we first need to understand the reigning heavyweight champion it's stepping into the ring against. That's what's widely known as the risk doctrine in asset pricing. So for decades, what has been this deeply ingrained belief that has held sway over how we think about stock returns?
Well, for many, many decades, the core idea, a veritable pillar of finance championed by titans like Eugene Fama, Kenneth French, Robert Merton, Stephen Ross, the core idea has been this. If any empirical characteristic return relationship, meaning if we consistently observe that a particular trait of a company, like its size or its book-to-market ratio, correlates with its stock returns, then that relationship must, sort of by definition, be explained by some underlying risk or factor model. That's a crucial starting point for understanding Lin and Zhang's challenge. The accepted wisdom was that these observable company characteristics, they're simply proxies, stand-ins, if you will, for some underlying undiversifiable risk factors that investors demand compensation for bearing. It had to be risk.
It had to be risk, so everything traced back to that.
Exactly. Think of it like this. In this framework, every premium you see in the market, that extra return you get for holding certain types of stocks, it has to be a reward for taking on extra unavoidable risk. It's like a detective story, where every clue you find, every characteristic that seems to predict returns has to lead back to the fundamental cause, which is risk. For instance, Fama and French, in their seminal papers from 93 and 96, they didn't just point out that factors like size, SMB, and book-to-market HML seem to predict returns. They argued these weren't just random correlations, they were actual risk factors. They posited that these factors mimicked underlying state variables. Think of them as aggregate economic conditions or uncertainties that were of hedging concern to investors. So basically, investors cared about these factors because they represented systematic, economy-wide risks you couldn't just diversify away. Right, risks you couldn't escape just by holding lots of stocks.
Exactly. And so they demanded a premium for holding stocks exposed to these risks.
Okay, so if the established theory said it had to be risk, how did researchers actually go about testing this risk versus something else idea? How do they try to figure out if it was genuinely risk or maybe something else entirely driving these patterns?
Well, the primary method that gained widespread acceptance for this task became known as the Daniel-Titman test, developed by Kent Daniel and Sheridan Titman in their really influential 1997 paper. This test was quite ingenious in its design. It was specifically crafted to, disentangle whether it was genuine fundamental risk or what they termed mispricing. Mispricing being essentially irrational pricing by the market. Was it risk or was it mistakes?
Okay, so how did they try to separate those two?
Here's how they did it, and it's quite clever. They constructed portfolios of stocks that had very similar observable characteristics. For instance, They might group together stocks that all had a similar book-to-market ratio, let's say all high book-to-market stocks. But here's the critical twist. Within those characteristic matched groups, they then ensure that the portfolios had different factor loadings. Now, factor loadings, remember, are essentially a stock's sensitivity or covariance to those fama French factors we just talked about, like how much a stock's return moves when the HML factor moves.
So similar characteristics, but different sensitivities to the supposed risk factor.
Precisely. The underlying logic was this. If risk is truly the primary driver of returns, then within these characteristic matched portfolios, the stocks that had higher factor loadings, meaning greater exposure to that purported risk factor, should also deliver higher expected returns. It was a direct test. Conversely, if returns didn't correlate with these factor loadings after you'd already controlled for the characteristics, well, that was often interpreted as very strong evidence against the risk doctrine. It implied that the characteristic itself, not its role as a proxy for risk, was doing the predictive heavy lifting. Daniel and Titman famously articulated this puzzle, writing, and I'm quoting roughly here, "In equilibrium asset pricing models, the covariance structure of returns determines expected returns. Yet we find that variables that reliably predict the future covariance structure do not predict future returns."
Wow, that quote really hits home. So the covariance structure, how a stock moves with factors, like its beta that's supposed to determine returns. But they found knowing that didn't help predict returns if you already knew the stock's characteristics, like its book to market.
Exactly. It's like having a detailed map telling you the sharp turns on a road. That's the covariance structure. But then you also know if the car is a lightweight sports car or a heavy truck. That's the characteristic. What Daniel and Titman found was that knowing the type of vehicle seemed more powerful in predicting its speed than just knowing the turns on the road.
Which must have been a huge puzzle for the field.
Oh, absolutely. Why would a stock's fundamental risk exposure, its sensitivity to market swings, not be the primary driver, especially when the theory insisted it should be? It left this big gaping hole.
And so what was the common interpretation when characteristics seemed to consistently win these horse races, as they were often called, against the covariance-based risk factors? How did that shape the narrative?
When characteristics empirically dominated covariances in these Daniel Titman style tests, the overwhelming and most common conclusion drawn by many researchers was mispricing. This interpretation suggests that investor behavior might be, at times irrational, leading to anomalies in asset prices that simply cannot be explained by fundamental risks. It implies that stock prices aren't always efficiently reflecting the true underlying risks, but maybe reflecting some behavioral biases or sentiment or misperceptions by investors.
So it opened the door wide for behavioral finance explanations.
It really did. The paper by Lin and Zhang cites various influential examples where these findings were used to bolster behavioral hypotheses. For instance, Daniel, Hirschleifer, and Subramaniam suggested that if low book-to-market or growth stocks consistently gave lower returns than their CAPM beta predicted, it could only be rational if they acted like insurance in bad times. But if they didn't provide that insurance, well, that smells like irrationality. Similarly, Barbaras and Thaler, who are, giants in behavioral finance, explicitly stated that a key feature of the rational approach is that factor loadings determine returns. So they concluded that Daniel and Titman's results were quite damaging to the rational approach. I know. And in accounting, Richardson, Sloan, and Titman, you distinguish between returns explained by covariance with risk versus returns attributable to the characteristic itself, which they saw as suggesting mispricing.
So for years, if you couldn't link a characteristic's return premium to a clear risk factor, the default explanation became investor mistakes or market inefficiency.
That was very often the case, yes. It really fueled the behavioral side of the debate.
So against this really entrenched backdrop of the risk doctrine and these ongoing, sometimes heated debates about mispricing versus rationality, Lin and Zhang introduced something new, something they call the investment approach. How is this fundamentally different from what we've just discussed, and what's its core sort of groundbreaking idea?
Well, the investment approach represents a truly profound shift in perspective. It really does. Instead of starting, as the traditional consumption-based models often do, with aggregate consumption decisions and these abstract economy-wide risks that are frankly quite difficult to pin down, this approach begins with the firm's optimal investment decisions. Think about it. Companies constantly decide whether to build a new factory, develop a product, acquire a business. These are tangible, real economic activities.
Right, things happening in the real economy. Yeah.
Exactly. And what Lin and Zhang do is connect stock returns, which are essentially the discount rates for a company's future profits, what investors expect to earn, connect them directly to observable firm characteristics. Characteristics like a company's investment levels, its profitability, its growth rate. And crucially, it does this without needing to establish those often complex, indirect, and frequently unobservable links to consumption risks that the traditional approach focused so heavily on. It's a bottom-up view, really, focusing on the real economic activities of firms and how those decisions ripple through to their stock prices.
It sounds much more grounded in, well, actual business.
That's the feeling, yes.
Yeah.
Bringing finance closer to the actual operations and decisions CEOs and CFOs make daily.
Okay, here's where it gets really interesting. This sounds incredibly intuitive from a business perspective. Could you give us a quick breakdown of its theoretical foundation? How do they build this model from the ground up?
Certainly. The investment approach is rigorously derived from what are called investment first-order conditions within a pretty sophisticated framework known as a general equilibrium production economy.
Okay, general equilibrium production economy. Let's demystify that a bit.
Right. So imagine an economy built on very clear, rational foundations, much in the spirit of, standard neoclassical economics. In this idealized economy, several key assumptions hold. One, rational expectations. All agents, individuals, and firms have rational expectations. They use the best info, understand how the economy works, no systematic forecasting errors. Two, maximization. Individuals maximize their utility, their well-being. Firms maximize their market equity, their value to shareholders. Everyone's acting rationally for the best outcome. And three, market clearing. All markets clear. Supply equals demand. No persistent surpluses or shortages.
So a world where everyone is rational, optimizing, and markets work smoothly.
Essentially, yes. And this general equilibrium production economy is crucial because it ensures all outcomes are stable, equilibrium outcomes. Within this setup, firms make investment decisions based on things like their internal productivity, how efficiently they make stuff, and any costs of adjusting their capital stock, what we call capital adjustment costs. Think of these as the frictions, the costs a firm faces when it tries to change its capital quickly, like building a new factory or shutting one down. It's not frictionless.
Okay, those adjustment costs seem important.
They are, and this whole process, the firm's optimal investment decision, leads to a really powerful and elegant identity. The stock return is mathematically equivalent to the investment return.
The stock return equals the investment return. That sounds, as you said, elegant, almost deceptively simple. But what does that mean practically? For us listening, how should we think about that?
That identity really is the beating heart of this approach. Its elegance is in its directness. In essence, it says that the return investors expect from holding a company's stock is exactly what the company itself expects to earn from its own investments. It connects the stock market to the business operations directly.
Okay, how does that work?
Let me break it down intuitively. Imagine a company deciding whether to invest another dollar today. It weighs two things. First, the marginal product of capital. This is the extra profit the firm expects to generate in the future from that additional dollar of capital. That's the benefit. If the firm's highly productive, that dollar generates a lot more future profit. Second, the marginal cost of investment. This isn't just the sticker price of the new machine. It includes the immediate cost plus those adjustment costs, the growing pains. Building a new factory disrupts things. You retrain workers, install systems. These are real economic costs, not just the bricks and mortar. That's the cost side.
Got it. Benefit versus the full cost, including friction.
Exactly. Rational firms will keep investing until the expected future benefit just equals the total cost. And here's the kicker. The return on that investment from the firm's perspective must be the same as the return investors demand from its stock.
Why must they be the same?
Because if there was a disconnect, say, if the firm could earn a higher return on its projects than shareholders were demanding, or vice versa, then either the firm would invest more or less, or its stock price would adjust until that equilibrium was restored. Things have to balance out. The paper makes a brilliant connection here. They state this approach is equivalent to the weighted average cost of capital, or WACC, approach used in corporate finance. That's a method managers use every single day to decide which projects to fund.
Wow, so it connects directly to standard corporate finance practice.
It does. So, for you, the listener, it's about connecting that somewhat abstract concept of expected returns, what you hope to earn on a stock, to the tangible decisions companies make about how much to invest, how profitable those investments are, and the costs involved. It brings finance much closer to actual business operations, making it feel less like a black box.
Okay, so the investment approach isn't just offering an alternative view. It's directly challenging that established risk doctrine in two really significant ways. Let's dig into the first one. This idea that characteristics-based factors like size or book to market aren't necessarily true risk factors in the traditional sense, even though they've been treated that way for ages.
Exactly. This is a crucial distinction that really shakes things up. Fama and French, for example, argued quite persuasively that factors formed on characteristics like size and book to market are genuine risk factors. They believed these factors acted as proxies for aggregate technological uncertainties or broader economic state variables investors would naturally worry about. That was the foundation.
They were stand-ins for fundamental economy-wide risks.
That was the argument. But the investment approach casts significant doubt on this premise. It suggests that for something to be a true risk factor in the rigorous sense of Merton's ICPPM or Ross's APT, it must represent a source of aggregate uncertainty that impacts all firms simultaneously. Think big, economy-wide shocks. A sudden drop in productivity everywhere, a major, unexpected shift in government policy, a broad shock to consumer demand.
Things that hit everyone at once.
Right. Those are the kinds of truly systemic uncertainties. The core argument here is that firm-specific characteristics, the very things these factors are built on, don't have immediate direct links with these broader aggregate sources of uncertainty. A company's book-to-market ratio reflects its own history, its specific investment and profit path. It isn't in itself an aggregate economic shock. Therefore, the paper contends characteristics-based factors are not truly ICPPM or APT risk factors. They might be correlated with risk, sure, but they aren't the source of the risk itself.
That's huge reclassification.
Yeah.
So if they aren't risk factors, what are they?
The paper proposes a much more, natural and straightforward interpretation. These characteristics-based factor models are simply linear approximations to the underlying, often nonlinear, firm-level investment return. For example, the size factor, small firms outperforming large, might actually be redundant to the value factor within the investment return equation. Why? Because a firm's size often primarily influences its market-to-book ratio. So what we've treated as an independent source of risk could just be another way of looking at a firm's internal investment and profit dynamics, just viewed through a simplified linear lens.
So less about fundamental risk, more about approximating the firm's investment reality.
Okay.
So if these characteristics aren't necessarily these aggregate risk factors, then what about the second big challenge? This is the idea that if characteristics empirically seem to dominate covariances in tests like Daniel Titman, it doesn't automatically mean mispricing due to irrational investors.
Yeah.
This has been a massive debate.
Absolutely right. This is a critical point. It directly confronts a cornerstone of the mispricing argument, which, as we said, fueled behavioral finance for so long. The paper strongly argues against the common interpretation that if characteristics predict stock returns better than covariances, if knowing book to market tells you more than knowing HML loading, it must be due to irrational behavior or market inefficiency. That's been the default conclusion.
But Lin and Zhang offer another explanation.
They offer a powerful, completely rational, economically grounded explanation for why characteristics predict returns. Remember the investment return equation, based on optimal investment, profitability, adjustment costs. This framework can naturally and economically predict many of the empirical relationships we see between these anomaly variables and subsequent stock returns. What have traditionally looked like anomalies to the consumption approach, that those puzzles often blamed on irrationality, could simply be regularities when seen through the investment approach lens.
So patterns previously labeled irrational might just be rational outcomes of firm investment decisions.
That's the core idea. Instead of seeing these patterns as market failures, signs of investor mistakes, the investment approach suggests they are natural, rational outcomes of how firms make investment decisions in the real economy. Firms, acting rationally, choose how much to invest, and those choices are intrinsically linked to their expected returns. This means a significant chunk of what we've called mispricing could simply be the rational, observable effects of corporate investment policy and profitability.
This raises a really important question for me, and I bet for our listeners too. If these two approaches, consumption-based covariances and investment-based characteristics, start so differently, how can both lead to rational outcomes? Are they incompatible, or is there a reconciliation?
That's the beauty of it, actually. It's where the paper offers a very sophisticated and elegant reconciliation. Lin and Zhang argue that these two seemingly disparate models, despite their different starting points, are actually theoretically equivalent in a general equilibrium. They're not mutually exclusive or competing. They are two sides of the same coin, ultimately delivering identical expected stock returns. They're complementary perspectives on the same underlying economic reality.
Two sides of the same coin.
Right.
How does that work theoretically?
The key insight comes from bringing together the two fundamental pillars. First, the consumption first order condition. That's core traditional finance, linking risk premiums to covariances. Investors demand higher returns for assets that pay off badly when money is most valuable in bad times. Second, the investment first order condition. That's Lin and Zhang's core, linking expected returns to firm characteristics via optimal investment. When you combine these two fundamental economic principles within a general equilibrium framework, they reveal an intrinsic, unavoidable link between covariances and characteristics. The paper formally shows how the risk-based prediction covariances are sufficient and the characteristics-based prediction characteristics are sufficient. Both hold true and are intrinsically linked. You can't really have one without the other in a fully functioning, rational economy. They're like different windows looking into the same complex machine.
Okay, that's a really deep point. If they're theoretically equivalent and linked, then why do characteristics empirically seem to dominate so consistently in tests like Daniel Titman? Why did that lead to all those conclusions about mispricing? There seems to be a disconnect between the theory and the data.
This is precisely where the paper offers its most powerful and empirically testable alternative explanation to mispricing. Measurement errors in our risk proxies. It's not that covariances aren't theoretically important. The fundamental problem is that in real-world data, they are often measured with significant noise, imprecision, and inherent difficulties. It's hard to measure risk accurately.
Hard to measure risk. How so?
Well, think about it. How do we estimate a stock's sensitivity to a risk factor, its beta, or loading? We typically use historical data, looking back at past stock movements relative to a market or a factor. This is inherently backward-looking, assumes past relationships hold, and it's highly susceptible to estimation error, especially when the true risk itself is constantly changing. It's like trying to hit a moving target with a blurry camera.
Ah, okay. Trying to measure something dynamic with static historical data.
Exactly. Characteristics, in contrast, like book to market, investment to capital, asset growth, are generally much easier and more precisely measured directly from a company's financial statements. They're observable, relatively stable values from the accounting data.
So one is fuzzy and hard to measure, the other is clearer.
Pretty much. So when you conduct a horse race between these two types of variables like Daniel and Titman did, you're not necessarily testing which fundamental driver is more important in theory. Instead, you're often conducting a test of which variable is measured more precisely in the available data. The variable with less measurement error will naturally appear stronger, even if the underlying theory says both are equally important. This reframes the whole debate, shifting focus from investor irrationality to the very practical, pervasive challenges of empirical estimation.
So for us listening, the truly profound insight is that what we've often interpreted as signs of an irrational market might just be our measuring tools being inadequate, our financial rulers are broken.
That's a great way to put it. It challenges the very idea of market anomalies, suggesting they could be perfectly rational outcomes, just obscured by noisy data.
This brings us to what I think is the most compelling and frankly maybe a bit unsettling part of their argument, the quantitative evidence. Lin and Zhang don't just theorize about measurement errors, they use a sophisticated model to actually simulate how these errors can bias our understanding. Can you walk us through the model they used and its surprising findings, especially when they compared it to real-world data?
Absolutely. To rigorously test their hypothesis, they employ a simplified version of a dynamic general equilibrium production model developed by Liu Zhang back in 2005. This isn't just some abstract theory. It's designed to be as realistic as possible while still being something you can analyze.
So what does this model world look like?
Well, instead of getting lost in equations, let's think about the economic reality it represents. Imagine a company trying to maximize its profits and value. The model carefully defines 1. A production function, how the company generates profits based on its efficiency and capital. 2. Capital accumulation, how it builds assets through investment, accounting for depreciation. 3, those crucial adjustment costs, the real growing pains or shrinking pains when changing capital quickly. Importantly, these costs are nonlinear and asymmetric. Maybe it costs more to ramp up than cut back.
Okay, so it includes those real-world frictions.
Yes. And finally, 4, a stochastic discount factor. This represents overall economic uncertainty, influencing how future cash flows are valued today. All firms in this simulated economy are rational, maximizing value, and the model is carefully calibrated to match key real-world financial stats. Amazingly, it even reproduces a value premium of 6.0% per year, similar to what we actually see.
Wow, so they built a rational mini-universe that behaves a lot like ours.
That's the idea, a perfectly rational, economically consistent world.
Okay, so they have this incredibly realistic, perfectly rational, simulated economy. What happens when they apply the Daniel Titman test, that famous horse race, to actual market data versus their simulated data? What do the numbers show?
Right, this is where the simulation really delivers the aha moment. First, they replicated the Daniel Titman test using actual U.S. market data from July 1973 to June 2010, sorted stocks into 25 portfolios, first by book-to-market, characteristic, then by HML factor loadings, covariance proxy. The results from this real-world data, exactly as Daniel and Titman found, book-to-market clearly dominates. After controlling for book-to-market, the HML loading showed only a tiny average return spread, 0.24% per month. Tiny? Conversely, controlling for HML loadings, book-to-market still generated a significant 0.70% spread. In finance, 0.70% month is huge.
So the real data seem to scream characteristics win, maybe mispricing?
Exactly. That's panel A in their table 1. Look like a clear win for characteristics. But then here's the kicker. They ran the exact same test on their simulated data from that perfectly rational Zhang model. Remember, this model is built with risk. It's a rational economy, no mispricing allowed. Yet the simulated data also showed characteristics dominating covariances. That's panel B. After controlling for book-to-market in the simulation, the HML loading generated an even tinier spread, just 0.02%. And controlling for HML, book-to-market still produced a substantial 0.31% spread.
Whoa. So even in a perfectly rational simulated world, characteristics still look stronger than the imperfectly measured risk loadings.
Precisely. The pattern was strikingly similar to the real data. The implication is profound. The empirical dominance of characteristics we see doesn't necessarily mean mispricing. It can emerge even in a perfectly rational model, likely due to the inherent measurement error in how we estimate HML loadings in the real world, and even in the simulation using standard methods.
That is a huge finding.
And to really hammer it home, they repeated the simulation, but this time using the true conditional betas from the model, the perfectly accurate God's eye view betas that you can only know inside the simulation, not the noisy estimated HML loadings. With these true betas, the spread across beta quintiles was a robust 0.33%, panel C.
So when risk is measured perfectly, it does predict returns strongly in a rational model.
Exactly. It shows conclusively that when risk sensitivities are measured accurately, covariances do have significant predictive power. The problem isn't the theory, it's the empirical measurement. It's those broken rulers.
So it's less about are investors irrational and more about are our financial rulers, the tools we use to measure risk, actually flawed. That is a mind-bending shift. But wait, if book-to-market still showed strong predictive power in the model, even when controlling for the true, perfectly measured beta, there must be something else going on too, right? And what about the way Daniel and Titman originally structured their test sorting first on characteristics? Did that introduce its own problem?
Yes, exactly. Even with perfectly measured risks, some biases can creep in. The paper identifies 2 additional key reasons for this persistent bias favoring characteristics, even using true betas. First, there's a significant correlation between true beta and book-to-market. In their model, and likely in reality, true beta and book-to-market are tightly linked, positively correlated. Both depend on the model's underlying state variables, like productivity and capital. Figure 1 in their paper shows this visually. The average correlation in their simulations is a hefty 0.66.
So they move together quite a bit.
They do. And what this means is if you try to purge the effect of the true beta from book-to-market, create a risk-adjusted book-to-market, its predictive power for returns in the simulations basically disappears. That's table 2, panels A and B. This is crucial. A large part of book-to-market's observed power isn't independent. It's driven by its strong correlation with fundamental risk. It's like finding red cars are faster, but only because red cars are often sports cars.
Got it. Part of the characteristics power is just reflecting underlying risk because they're correlated.
Right. And second, the order of the sorts in the Daniel Titman test matters. A lot. The test sorts sequentially, first on characteristics, then on covariances. This specific order significantly exaggerates the perceived power of characteristics. The paper shows powerfully that if you reverse the sorting order sort on HML loading or true beta first, then on book to market, the relative power of covariances is substantially strengthened and characteristics are weakened. That's panels C and D in Table 2.
Seriously, just changing the order of the sort changes the conclusion.
Significantly. They even confirm this on real data. Reversing the order boosts HML spread from 0.24% to 0.40% and cuts book to markets from 0.70% to 0.63%. The sequential sort gives an artificial advantage to the first variable. How you ask the question heavily influences the answer. It's a methodological trap.
That's fascinating. So it's noisy data and how we test it. Beyond these specific biases, what are the general broader sources of measurement errors that plague risk proxies in the real world, making them so hard to pin down?
You've hit on a critical point. It's a multifaceted problem. Several pervasive sources consistently challenge empiricists. The first major one is time variation in betas when using rolling windows. Most empirical betas, like from 36-month rolling regressions used by Daniel and Titman, are basically averages from the past. But a stock's true beta, its real risk sensitivity, is rarely constant. It changes over time, the company changes, the economy shifts. This time lag between estimation and portfolio formation significantly weakens the power of estimated betas to predict future returns, like predicting tomorrow's win using yesterday's average.
You miss all the current dynamics.
Exactly. Simulations show this bias is quantitatively large. Using rolling betas gives a spread of only 0.12% per month, way down from the 0.33% with true betas. A huge drop in power. The second major source is specification errors when estimating conditional betas. Researchers try to capture time-varying betas using linear models with economic instruments like interest rates or growth figures, but the theoretical links between these instruments and true betas are often highly nonlinear. So forcing a linear model onto a nonlinear reality introduces big specification errors, like fitting a straight line to a curve.
You're guaranteed to be off.
Often by a lot. The paper simulations using such a linear conditional beta model also show a substantial bias, underestimating the true beta's power, getting a spread of only 0.11% versus the true 0.33%. These errors aren't minor, they fundamentally distort our view.
Wow. This all sounds like a huge, pervasive problem for practitioners, for anyone trying to use these models in the real world, making investment decisions, valuing companies, assessing risk. What's the real-world impact?
The direct and most significant consequence is that cost of capital estimates derived from these traditional risk-based models become incredibly unreliable. Think about it. The cost of capital is arguably one of the most important numbers in corporate finance, used for everything from project selection to M&A evaluation to performance benchmarks. If you can't accurately measure a stock's risk is beta or loading or pin down the market risk premium precisely, then your calculated cost of capital is likely to be way off. This isn't just academic, it affects real money decisions.
It sounds like building on shaky foundations.
It does. The paper cites leading accounting academics expressing deep disillusionment. Lundholm and Sloan, well-respected voices, lamented back in 2007 something like, "None of the standard finance models describe the data well. The best we can hope for is a good understanding of what it represents and some ballpark range."
Just a ballpark. That doesn't sound very precise for billion-dollar decisions.
Not at all. And Penman, another giant in accounting, expressed extreme pessimism in 2010. He wrote something like, "Compound the error in beta and the error in the risk premium, and you have a considerable problem. The CAPM, even if true, is quite imprecise when applied. Let us be honest. No one knows what the market risk premium is." He added that using multi-factor models just adds more things to estimate badly, suggesting it often contains a strong element of smoke and mirrors.
Smoke and mirrors. Ouch.
It highlights a profound issue. If the very building blocks, betas and risk premiums, are so inherently problematic to measure, the whole structure built on them for cost of capital is unstable, unreliable, potentially misleading. Fixing on these elusive risk factors might just be a futile exercise in practice.
Okay, given these really strong arguments challenging decades of dogma, the investment manifesto is certainly bound to face criticism. The paper dedicates a whole section to replying. Let's tackle them. First, how does the investment approach respond to the common question? Does it actually explain anomalies in a way that satisfies the rigorous demands of finance? What counts as an explanation?
Right. Critics often raise a few key points. They argue a rational explanation needs to account for common factors related to anomalies, implying unknown systematic risks. They also claim return predictability implies time-varying risk premiums, which they feel the investment approach doesn't explicitly model in the traditional sense. The paper addresses these by reframing explanation. Let's start with the myth of common factors. The paper argues there's nothing mysterious about common variations and characteristics-based factors. They're not new sources of systematic risk. Instead, as we discussed, these factor models can just be interpreted as linear approximations of the underlying nonlinear investment return at the firm level. If a characteristic, say book to market, helps predict returns cross-sectionally, it's logical its factor-mimicking portfolio will show power in time series regressions too. The paper emphasizes factor loadings risks, and characteristics are economically equally primitive in explaining expected returns. Characteristics might even be more useful practically because they're measured better.
So common factors aren't mysterious risks, just reflections of commonalities in investment returns approximated linearly.
That's the argument. Then there's predicting risk premiums, which they equate to predicting discount rates. Given a relatively stable risk-free rate, predictability in stock returns largely is time-varying risk premiums, and time-varying risk premiums are basically time-varying discount rates. In the cross-section, since the risk-free rate is the same for all, the variation in expected returns is the variation in risk premiums. So when the investment approach models expected returns via characteristics, it is, in effect, modeling risk premiums, just from a firm-level view, avoiding the problematic estimation of that pricing kernel M.
Ah, okay, it is modeling risk premiums just indirectly through characteristics.
Exactly. Finally, the failure of the CAPM critique. Critics point out that anomaly portfolios often have similar market betas, which CAPM can't explain, like HML having near zero beta post-1965. The paper acknowledges some specific models, like Zhang 2005, might struggle to perfectly hit that zero beta. However, it highlights that in longer samples, 1927-2010, HML's APM alpha is insignificant, and its market beta is a non-zero 0.45, figures the model simulations actually get close to. More importantly, the investment return framework itself is immune to specification errors in that pricing kernel or measurement errors in consumption data. It offers a more general, robust foundation that doesn't rely on getting M right, which is notoriously hard.
That's a crucial point. You mentioned the pricing kernel M again. Can you quickly demystify that? What exactly is M and why is it so hard to nail down?
Absolutely. Think of the pricing kernel, M, as basically a sophisticated way of describing how investors weigh future cash flows. We know a dollar today is worth more than a dollar tomorrow, time value, and a risky dollar tomorrow is worth less than a safe one, risk aversion. M captures both, impatience and risk aversion, especially in different economic scenarios. It discounts future cash flows back to today, not just for time, but crucially for risk. It tells us how much investors value money in good times versus bad times.
So it reflects aggregate investor preferences and risk aversion.
Exactly. And the reason it's so notoriously hard to measure is that it requires knowing aggregate investor preferences, how all investors collectively feel about risk and consumption and how that changes. That's incredibly complex, often unobservable. We can't peek into the market's collective mind. We infer M from aggregate consumption data, which is noisy and might not perfectly capture the marginal utility of the representative investor. So any model relying heavily on accurately specifying and measuring M faces a huge empirical hurdle. That's why the investment approach, focusing on observable firm characteristics, is so compelling.
Got it. Okay, this raises another important question about causality. The traditional risk doctrine often implies covariances determine expected returns one-way street. How does the investment approach challenge this view?
This is where the paper really flips conventional thinking. It's subtle but powerful. It argues that in a general equilibrium production economy, which is much closer to the real world than simpler models, risks, expected returns, and characteristics are all endogenous variables. They aren't independent forces acting on each other. They are determined simultaneously by a complex system of equilibrium conditions. No simple one-way causality from covariances to returns or vice versa. They're intertwined, co-determined.
So not A causes B, but A, B, and C all arise together from the underlying system.
Precisely. Think about different theoretical economies. In a simple endowment economy, fixed pie, firms just distribute, covariances would determine expected returns. In a linear technologies economy, frictionless investment, characteristics like profitability would determine returns. But the real world, Lin and Zhang argue, is an adjustment costs economy. Firms face real costs changing capital. Here, both the consumption first-order condition, EMR equals 1, linking risk to M, and the investment first-order condition, stock return, investment return, linking returns to characteristics, are key. Expected returns aren't exogenously set by risk or by productivity alone. They emerge from the whole system working together.
Yeah. So the punchline on causality is,
The investment approach is no more and no less causal than the consumption approach. Neither explains anomalies in a purely causal sense. They both describe facets of equilibrium relationships. It's a holistic view, not a simple cause-effect chain.
okay, that's a big shift. Another common critique: anomalies are often seen as strong evidence of investor irrationality. What does the investment approach say about this behavioral interpretation?
It provides a really powerful alternative to automatically jumping to irrationality. By focusing on firms' optimal investment decisions and their technology production functions, adjustment costs, it shows that observed empirical links between characteristics and returns can be perfectly consistent with rational behavior by both firms and investors.
How so?
Well, from the firm's side, rational firms invest more when their cost of capital is low, projects look better, and less when it's high. This rational alignment naturally shows up in characteristic return relations. For example, a firm with high asset growth might rationally have a low expected return because its low cost of capital prompted that investment surge. A firm with low profitability might have a high expected return, high cost of capital deterring investment. These are rational firm responses.
So the patterns reflect rational firm actions, not necessarily irrational investors.
Exactly. The key takeaway is the investment approach doesn't prove prices are rational. To do that, you'd need both EMR1 and the investment return equation to hold perfectly in the data a very high bar given measurement issues. But, crucially, it certainly doesn't prove they're irrational either. It strongly suggests that what behavioralists see as failures of the rational paradigm, like EMR1 not working well, could just be specification errors in M or measurement errors in risk proxies. It challenges the assumption that if the tricky consumption model fails, rationality itself must fail. It offers a coherent, rational story for many anomalies.
It provides a rational alternative explanation, which is huge. Okay, finally, some critics apparently dismiss the investment return test as just a weak consistency test, implying it's not deeply explanatory, just a minor check. How does the paper counter this?
They strongly refute this notion. They argue the investment return test is far from weak, it's fundamental. First, they emphasize the restriction that expected investment return equals expected stock return comes directly from the investment first-order condition. This condition, they argue, is as primitive and fundamental for the firm side as EMR1 is for the consumption side. It's not ancillary, it's core economic theory.
It's a basic building block.
Right. Second, testing this ex-ante restriction directly addresses the core question. Why do portfolios formed on characteristics earn different returns? It speaks to the very essence of the cross-section puzzle. Third, and this is insightful, unlike the consumption approach, mostly about expected returns, the investment approach also sheds light on ex-post returns, what actually happens. This helps interpret things like patterns around earnings announcements. Behavioral folks might see overreaction, but the investment approach offers a rational view. Without adjustment costs, ex-post investment return is just profitability, so returns realize around earnings news. Even with costs, much of it does, it links returns to real performance.
So it explains realized returns better than the consumption model.
It offers a framework for thinking about them rationally, yes. The consumption model is largely silent on ex-post returns. Finally, on practicality. While testing the exact 100% in R2 investment return equation is hard due to measurement errors, the authors advocate focusing on components of the investment return like investment to capital and profitability that are more robustly measured. These components can then be used to forecast returns more reliably, a strategy researchers like Hu, Bi, and Zhang have shown works empirically. It's about being smart and practical with messy data.
Wow. This deep dive has really turned a lot of traditional finance on its head, challenging assumptions about risk, rationality, measurement, just so much. So to bring it all together, what's the ultimate overarching message of the investment manifesto for the finance world and for us as listeners?
The core message is undeniably bold, provocative. It challenges the very direction of research for decades. Lin and Zhang contend that the decades-long, painstaking search for universal, aggregate risk factors to explain anomalies is, in their words, baseless and hopeless.
Baseless and hopeless. That's strong language.
It is. Baseless because the identity of risk factors isn't a clear, testable implication from fundamental equilibrium theory. First-order conditions are more fundamental. And hopeless because pervasive measurement errors in risk proxies will, as they put it, forever doom covariances and horse races against characteristics. The empirical noise is just too great.
So stop searching for those elusive risk factors.
That's the implication. Instead, the investment approach offers a new basis for asset pricing research. It empowers us to infer the cost of equity, the expected stock return, directly from observable firm characteristics like investment and profitability. This perspective suggests asset pricing isn't all about the pricing kernel and aggregate risk, the consumption approach focus. Characteristics are the equally vital other half, completing the picture in general equilibrium. It's a paradigm shift, moving towards more observable, less ambiguous drivers of returns.
But even a manifesto, as groundbreaking as this one, must have its limits right. It can't solve everything in finance.
Indeed, you're absolutely correct. The authors are very clear. The investment approach isn't a complete standalone solution for everything. For example, it's largely silent on the fundamental sources of risk. It doesn't tell us what constitutes bad times or why investors fear certain stocks. That requires digging into utility functions, consumption shocks, more the consumption approach's domain. And it's not designed for pricing complex derivatives like options or CDS.
So it has its specific domain.
Exactly. But where it truly shines and provides powerful, robust insights is into the cross-section of returns, explaining why different stocks have different expected returns. This is an area where the traditional consumption approach has really struggled empirically, so it fills a critical gap, complementing other areas of finance. It gives us a clearer lens for understanding ordinary stock returns.
It's a powerful and provocative paper. And this deep dive really makes me wonder if the current paradigm might have been, as they suggest, barking up the wrong tree for 4 decades in such a core area. What other long-held assumptions in finance, or even broader economics, might be due for a similar thorough, deep dive reevaluation? It really shows how science progresses, doesn't it? Even in finance.
That's a fantastic question. It certainly makes you think.
And that's a fantastic thought to leave you, our listener, with. Definitely something to ponder. Thank you for joining us for this deep dive into the Investment Manifesto. We hope it's given you plenty to think about and new ways to look at the financial world around you, especially the next time you hear someone talk about risk factors or market anomalies.